Hey everyone. Today, we are cracking open the latest earnings report from Coca-Cola. But listen, this is way more than just a bunch of numbers on a page. This is really the story of a huge shift happening at one of the most famous companies in the world. We're talking about a longtime leader stepping down and a brand new vision for the future. All right, let's get right into it.
And it all kicks off with this, just 7 words from the outgoing CEO, James Quincy. With that one sentence, an entire era at Coca-Cola officially came to an end. It totally set the tone for the entire call, and it signaled that everything we were about to hear wasn't just about the last few months, but really about what comes next.
So this whole story is really framed by these two people. On one side, you've got James Quincy, the guy who basically built the company's strategy for the last decade. That's his legacy. And on the other side, you have Enrique Braun, who was handpicked to take over and write the company's next chapter. It's a classic tale of transition.
Now, before we can really wrap our heads around where Coke is going, we've got to understand where it's been. So let's take a quick look back at the powerhouse foundation that was built during the Quincy era.
Under his leadership, the company's portfolio just exploded. I mean, think about this. They grew to have 32 different brands that each bring in over $1 billion. That's up from just 20 a decade ago. This was never just about selling more classic Coke. It was a really smart, strategic push into things like juices and teas and water, diversifying way beyond soda.
And you know what? That strategy absolutely paid off. Pulling off 7% average organic revenue growth every single year since 2017, well, for a company this massive, that is incredibly strong and consistent. It just shows you what a well-oiled machine they were running during his time.
But here it is. This is the number that really gets investors' attention. During his time as CEO, Quincy's leadership created more than $150 billion in market value. So let's be clear about what this means. The new guy, Enrique Braun, he's not taking over a fixer-upper. He's inheriting a very strong, very valuable company.
Which brings us right up to today. With this huge transition happening in the background, how did the company actually do in its latest quarter? Let's check out the scorecard.
And the results were, well, they were a little complicated. On the one hand, you've got the good news. They were actually more profitable than anyone expected, beating the earnings per share estimates. But on the other hand, the bad news. They just didn't bring in as much money overall, missing the revenue targets. And that's really the central puzzle of this whole report. Now, what's so interesting here is seeing the raw numbers side by side. That 2-cent beat on earnings per share, that's solid. It shows they're doing a good job managing costs. But that revenue miss, that's a pretty big deal. We're talking over $200 million less than what Wall Street was banking on. This gives you that perfect, clear picture of the mixed report card we were just talking about.
So why did they miss on revenue? Well, the answer is all about geography. Their performance was really a tale of two different worlds. While North America had a fantastic quarter, some of those key growth markets like China and India showed some real softness. That's probably because of shifting consumer habits and some local economic pressures. It just goes to show you how a global giant like Coke can be crushing it in one place and facing major headwinds in another, all at the same time.
Okay, quick pause. Before we look ahead, we have to define a key term you hear all the time in these reports: organic revenue. Just think of it as the purest way to measure a company's health. It's the growth you get from your main business once you strip out all the noise from things like currency changes or buying other companies. This is the number that management is really paying attention to.
All right, so let's turn the page and look to the future. Now that we have all the context from the past and the present, it is time to look at the new CEO, Enrique Braun, and his vision for how he's going to steer this massive ship forward.
Braun laid out a really clear 3-part plan. First up, a major focus on recruiting young adult consumers. Second, figuring out how to get new products and cool innovations onto store shelves much faster. And third, going all in on digital, making it the absolute core of everything they do, from marketing campaigns to how they connect with their bottling partners.
And let's be super clear here. This is not about throwing out the old playbook and starting from scratch. No way. The whole strategy is about balancing the incredible power of those iconic brands we all know with a brand new, relentless focus on digital and really understanding what local customers want. It's all about taking that powerful legacy and making it exciting for the next generation.
So what does all this mean for the bottom line? How does this new vision actually translate into dollars and cents? Let's take a look at their official forecast for next year.
Here is the game plan for 2026. They're aiming for 4 to 5% organic revenue growth, which is right in that sweet spot for their long-term goals.
They also think they can grow earnings per share by 7 to 8%, partly because they're expecting a nice little boost from currency exchange rates. And on top of all that, they're forecasting a massive $12.2 billion in free cash flow. What all this guidance really signals is a kind of quiet confidence that their new plan can deliver steady, predictable growth.
Which leaves us with this one big question at the end of the day. The company's own leadership described the current economy as a light drizzle. So, can this new vision, this focus on youth, speed, and digital, be the engine that powers Coca-Cola through that uncertainty and helps it hit its really ambitious goals? I guess only time will tell. Thanks so much for tuning in.